Simona, you have the floor.
Great, thank you very much. Well, thank you for inviting me to present at this conference, and also thank you for a great choice of discussants. So I'm very much looking forward to the comments afterwards. So what's the motivation of this paper? Well, if you've done some research on mutual funds, and there is a lot of research on it, you will know that a lot of people have worked on benchmarks and trying to classify mutual funds into styles. We have just heard a lot about that with this mutual fund and Morningstar presentation. And here we focus on active equity mutual funds, but the idea is the same. We have all these benchmarks, and these benchmarks are generally based on quite standardized dimensions like size, value, etc. And somehow that feels quite unsatisfactory when we're trying to explain either the proliferation of funds, the increase in assets under management, and more in detail, what is exactly attracting investors to a certain style. If we think that investors are just looking for size, value, or momentum, they could have access to that through simply smart beta investment. And so with that in mind, what we did, particularly with this focus on active equity mutual fund, was to look directly at what funds tell investors about their strategies and their risks, and compile a comprehensive data set of the risk and strategies descriptions that funds provide to investors through their prospectuses. So what we do is that we systematically analyze these narrative descriptions of funds, and we use this to construct some peer groups. What are peer groups? Peer groups are groups of funds that, at least in what they tell investors, they have very similar strategies to each other. And what we do is that we map this industry into some distinctive peer groups, both in the dimension of risk and in the dimension of strategy, which are of course much more detailed than the classic style, value, and momentum. And then we check whether the textual similarity in what these funds disclose to investors actually translates in similarities in their actions. And in particular, we look at return distributions, risk-adjusted performance, and risk exposures. So let me give you a kind of a brief overview of our findings before we go into the details and the nitty-gritty of things. So the first thing when we started our project, as some of our colleagues were telling us, is, well, this is just boilerplate. For legal reasons, they need to write something, and it satisfies the legal reason if in my description of my strategy I say I pick assets in order to generate returns from my investors. That's not very informative. So you might think that funds converge to a very standardized, sweet and short description for their strategy, and a very long and comprehensive description of risks that includes everything under the sun. So the first thing that we do is that we collect this comprehensive data of the full description of their strategy and risk. And the first thing we say is just sanity check. Is there a lot of variation in there, both in terms of length, complexity, sentiment, and all of those basic things that we usually look at when we're thinking about textual analysis? And what we find is that we reject the hypothesis that prospectuses are just boilerplate. So there is something in there. The second point is, well, what is in there? Is it just purely marketing material? So I am saying things, but that don't actually reflect on what I am doing. So maybe investors are reacting to this. They are reacting to what I am saying in the strategy descriptions, but the strategy descriptions actually don't translate in any differences, measurable differences in returns, performance, etc. And we can also reject this hypothesis, as in fact we find that ex-ante textual similarity and ex-ante categorization into a particular peer group does translate into distinctive and more similar return distributions ex post. So we reject the fact that what they say they're doing doesn't translate into some kind of action. What is puzzling here, though, is that the way in which we think about this industry and how investors should be reacting to their choices of funds, particularly if I'm going to an actively managed fund, so I'm paying high fees for this, is that I should be expecting some risk-adjusted performance. If all I'm getting is my exposure to value, size, and momentum, I can get that for cheaper. And particularly if there is such a proliferation of strategies, we would expect that each of these strategies would have some distinctive profile in terms of risk-adjusted performance. And here we find nothing. We actually reject the hypothesis that these funds would have a significantly different risk-adjusted performance. That's puzzling. So they're saying something, it is informative, it translates into these actions, but these actions don't actually reflect in what we think investors should be caring about. So a possible reconciliation, and what we have actually been working on and expanding the paper in that direction, is thinking about risk exposures. So it is true that after controlling for all of the standard risks and factor models, we don't find significant differences in performance, but actually there is a very rich factor structure and different styles of funds, and you will see these styles are quite detailed in the type of strategies and risks that they're exposed to. They actually provide a very rich combination of risk exposures, not only in terms of the classical factor structures that we use to explain equity returns, but also to exposures to macroeconomic factors that might matter differentially for different types of investors. So I would think that a retail investor probably cares more about not being exposed, hedging against unemployment risk, whereas a more institutional investor cares more about future growth in the economy and things of that type. So this is a potential way to reconcile that. We do find that this textual analysis gives us significant strategy and risk peer groups that are much more detailed and rich in their description than what we can get from a simple 3x3 Morningstar style construction. And it does look like they are catering to a potential preferences of investors for different risk exposures. Work in progress is to more directly link these preferences to differences in risk exposures, and then also think about, okay, if investors want this, does it mean that they should want this? Are they actually getting value for what they're paying for these extra fees for these actively managed funds? So with respect to the literature, this is obviously not a comprehensive literature because there is just so much about mutual funds and benchmarking, but definitely our paper relates to mutual fund benchmarking, and we know all of the classics that I have listed here, and there are many, many more. It also has to do with textual analysis and machine learning. In particular, there have been quite a few things from the seminal work of my colleague Paul Tetlock to more work with more advanced, more data science techniques more recently. And then it has to do with a lot of research that's done on Edgar filings. So most of this research has to do with 10Ks, so company filings. Here we look at mutual fund filings. In that respect, the closer paper is Kostovetsky and Werner. And so Hans, thank you so much for the discussion, because I'm very much looking forward to his opinion on our paper. So what they do here is that they also look at the strategy description, actually a part of the strategy description of these funds. And their perspective is that within a certain class of funds, and within a certain style, let's say within a certain Morningstar style, they try to identify unique funds and look if investors are responding to this uniqueness. And so the idea is kind of similar in terms of looking at proliferation of funds by this demand meets supply kind of idea with this proliferation of preferences of investors. But we're taking kind of the opposite view. In a sense, we are not trying to identify the unique funds within known styles. We're trying to take the kind of big picture approach of actually mapping the industry into styles and understanding more of this broader view. So I really see these two papers are being complementary and kind of going in a similar direction of thinking about investor preferences. So what's the roadmap? So a few words about the data, and then I'm going to get into more detail on those 4 hypotheses and kind of answers that we gave to them that I mentioned at the beginning. So with respect to the data, just a few words. You now know a lot about mutual fund filings, well, already from the previous presentation, but you know that funds are required to publish prospectuses regularly to the SEC. And there are some clear guidelines regarding the information that this should contain. And in particular, the SEC provides some templates to funds that have some numbered questions. And for each question, there is some guideline on what type of answer they need to give. Here we focus on 2 particular sections of the prospectuses, the principal investment strategies and the principal investment risks. These are 2 specific sections where funds need to provide a narrative description of what are their main strategies, so what is the main way in which they select assets, and what are the main risks that a particular fund is exposed to. This regulatory requirement can be satisfied in just writing a few sentences, and indeed some funds do that, but many funds write much more. So there is some discretion in cross-sectional differences on how to satisfy this requirement, but the good thing is that they're all obliged to comply. So funds, by the way, are sued by the SEC for misrepresenting themselves, particularly also in these sections. There are a number of examples, and the SEC has also made some big example of some known funds as a deterrent. These prospectuses are publicly available through the Edgar system. Retail investors can access them through just clicking through things and reaching the prospectus. If you are an institutional investor, you're a researcher like us, you can automate the download of these things. And there are many ways in which this information can be accessed. And we also think of it as kind of a proxy of different ways in which you could get information about these funds. Say your financial advisor has read this stuff and you talk to your financial advisor, that's an indirect way to get that information as well. So what does our data look like? I'm not going to spend much time on the numerical variables. It's the classic mutual fund data set. It has CRISP, and with respect to the holdings, a small innovation that a few of the recent papers are doing. We use both Thomson Holdings and CRISP Holdings because CRISP Holdings are more comprehensive in later years. Now, the other part of the data is that we map to this standard mutual fund data set, strategy and risk descriptions for all of the different fund month observations of interest. That's not a super easy task, so Morningstar does provide an excerpt of the strategy description. I think is the first 100 words or something like that of the strategy description. We find that these descriptions are quite a bit longer, and when we're trying to use them to map the whole industry, it's important to get the full picture and to get multiple of these sections, as in, for instance, here we're looking at strategy and risk, but we are planning to also look at different ones. So let's get to the interesting part, the textual characteristic. That's the first thing that we did, kind of saying, okay, is this just boilerplate? So in this graph, what you can see is the distribution of the number of words that funds use in order to describe their strategy and their risk. This is pooled both in the cross-section and the time series, so it has all of our observations. What you can see is that all of these funds are answering the same question and they're satisfying the same regulatory requirement, but some of them write significantly more than others. Another thing that, so the cross-sectional variation is the first thing that we're interested in. Another thing that kind of corresponded to our intuition is that funds write much less about their strategy and much more about their risk. I don't want to reveal my secret sauce, but if I am sued, I want to be able to say, well, it was written in there. And so that kind of matches our intuition on the quality of the data. Another thing that actually was quite surprising is that there is a large cross-sectional dispersion in complexity of the text. Here, these are flat Kincaid measures that look at years of schooling necessary to understand a certain text, but we use all of the standard measures of complexity. And I think three things jump out of this picture. One is that there is huge cross-sectional variation on complexity. The second one is that the strategy is much more complex than the risk. That, again, lines up with that intuition. The risk needs to be simple. If I am sued, I need to say, I told you so. And the other thing, though, that is quite surprising is to understand the vast majority of this, you need to have completed your high school and you need to have potentially a university degree and so on. And that's not in line at all with what the SEC actually mandates, because there is a Plain English Act that actually mandates funds to write in plain English, and that does not transpire from our analysis. So, first hypothesis, fund prospectuses are just uninformative boilerplate. At least it doesn't look like it is boilerplate. There is significant variation in there. There is also significant variation in terms of sentiment. So if we look at, for instance, the frequency of positive, negative, uncertain, or litigious words, I also have the distributions. There is a large cross-sectional variation there as well. But also we see as a sanity check that indeed the strategy section contains more positive words and fewer negative, uncertain, or litigious words than the risk section. This also lines up with our intuition. So Again, it doesn't look like it's boilerplate. There is something going on there, but what is it? So this is basically our descriptive statistics of the data, just some sanity check. So what do we actually do to analyze this industry and kind of try to map it based on these textual descriptions? So we try to form these peer groups. We don't call them benchmarks, we call them peer groups, because it's really who are the funds that are providing a product that is similar to the one that I'm providing and that could potentially attract similar clientele. So what we do, we use an unsupervised learning method, clustering, in order to group funds into clusters that contain similar text. So what this does, we use k-means. It's a very simple algorithm. It's probably the simplest one that you can think about. And we were really trying to go for something simple, given the fact that it's actually quite robust in our setting. So what the k-means does, well, we first represent all the text in the usual way of a term frequency matrix. Rows are the sections, columns are all the words and bigrams. And then we basically randomly assign all of these excerpts into some clusters. And then here we calculate of each cluster its centroid. And then we get new centroids as the mean of the vectors assigned to each of these clusters. And we repeat these iteratively until basically the centroids don't change much. So until we have reached a distribution of the whole industry into some reliable clusters. Now, this procedure is repeated independently for strategy and risk sections, and we don't impose anything like different observations of the same fund need to be put in the same cluster. But that does happen naturally, which is another kind of robustness check of the methodology. So the one thing that is required, the only hyperparameter that is required here, is to tell the algorithm what is the number of clusters that I want to split this universe into. In this case here, we're using 15 clusters for strategy and 12 for risk. We actually develop a quite intuitive methodology to refine what should be a reasonable number of clusters in here, using some criteria like density and stability. What does that mean? We don't want to have, if we split more, if we add more clusters, and what that does is that it splits some larger clusters into some tiny ones that are semantically very similar to another existing cluster, we've probably gone too far. The other point is stability. So whenever we increase the number of clusters or decrease the number of clusters, the majority of the observations should be actually jointly categorized in the same group. We don't want things jumping around too much. Hence, we don't want this to depend too much on whether we put 11 or 12. And as a matter of fact, everything that I'm going to show you is robust, choosing between 10 and 20 clusters. So some examples. When I do this clustering, what I get is that for each one of these strategy peer groups or risk peer groups, I have a full distribution over words. What does this group represent? And then I can represent that in word clouds. So these are just some examples, because obviously there are too many to show you all the word clouds. But this is an example of the strategy peer group that we label long-term. Please note that the labels are just for interpretation. They're not needed for anything in the analysis. But this is a cluster where funds really speak about having these long-term investments, selecting funds to hold for the long term, and so on. Another example, the quant cluster. I'd actually, in a separate research, I do an analysis on quant versus non-quant funds, and with a completely different methodology, I also retrieve these quantitative investors. So it's nice that they kind of emerge naturally from this procedure. And these are some examples of the risk peer groups. So this is a peer group where the funds that are in this group, they're mostly distinctive because they speak about derivatives risk more predominantly than others do. And these other funds talk about interest rate risk. Note that these are all equity funds. So they're funds that invest at least 80% of their assets in common stock. But they can also hedge some of these positions with other assets, and some of that emerges in the risk and strategy descriptions. Now, this is a full mapping. I haven't shown you the word clouds for all of them, but what this tells me is we have here the strategy peer groups that we identify, and here the risk peer groups, where a longer bar means more observations, fund month observations are assigned to that particular cluster. The numbers in here is the number of unique funds that at some point in time in their life are assigned to that cluster. Funds can be assigned to multiple clusters over time, but we do check, and the vast majority is assigned to 1 or up to 3 clusters throughout their life. So that's also quite robust. Now, as you can see, this style categorization, this peer group categorization is much, much more detailed and more insightful than just talking about the classic characteristics. So we have funds that talk about this long-term approach to their strategy, funds that talk about industries, quantitative funds, funds that stress on the use of leverage. Of course, we have the small cap, and this actually lines up with kind of characteristic-based classification, and so on and so forth. We have some quite interesting things like funds that speak about the fact that they aim at investing in companies that provide dividends. And in the risk peer groups, again, we also have a much more detailed categorization than we would normally. So we have funds that stress on growth and size, like we would expect, but others that stress on the use of derivatives, interest rates, or exposure to real estate. One more thing that we do is that then we take all of these strategy groups and we say, well, in these strategy peer groups, what is kind of the split of what are the risks that we mostly talk about? And here you can see that in particular funds that are in this foreign category speak a lot about country or currency risk, real estate strategy peer groups speak about real estate risk, and so on. And it's also interesting to see in other groups what is kind of the breakdown of the different risks that funds in a given strategy would be exposed to, or at least that they say they would be exposed to. Now, once we have this mapping, what we want to do is say, okay, it's not boilerplate, but does it match to actual actions? Does textual similarity ex ante means more similarity ex post in outcomes that investors would care about? So the very first thing is kind of the first pass at this. You want to look at, does a simple measure of textual similarity ex ante, even without looking at the peer groups, does a simple Euclidean distance in the text, does that predict future similarity in moments of the return distribution, mean, standard deviation, skewness, kurtosis? We find that both for risk and strategy peer groups, Euclidean distance does predict future similarity in moments of the returns, meaning the more similar is our text ex ante, the more similar our returns look ex post. This does not use our categorization yet. So what we do then is that we actually take our peer groups and we estimate empirical return distribution, so the full distribution of returns, and we do that for good times and bad times. And then we ask, well, are these distributions meaningfully different from each other? And what you can see here is that, for instance, in good times, in actually we should call them low volatility and high volatility times, you see that the fixed income and dividends clusters, peer groups, are the most distinctive together with the small cap one. But for instance, you see that the fixed income group actually becomes not that distinctive in high volatility periods. And that makes a lot of sense because if you think about it, this 20% of non-equity assets, they're probably invested in corporate bonds. And in these times is when the cash flows of these companies are impacted. And so the correlation between the kind of their equity and their debt would increase. So we do that for both the strategy peer groups and the risk peer groups. Yes?
Simona, hi. So you're over time. You're like 3 minutes over time.
Sorry, I did not see your thing.
Yeah, sorry.
1 minute and I will wrap up. Yes.
Okay.
Sorry, I did not realize. I didn't see the caption. We don't find any difference in risk-adjusted performance, as I mentioned earlier, but we do find significant differences in their factor exposures and in their exposure to macroeconomic variables, which line up with interpretations, like, for instance, the dividend cluster, basically their exposure indicates that they would be investing in more established companies that would be paying more dividends in the future. So our interpretation, basically, probably these investors, these funds are proliferating into these strategies for providing a more different risk exposures for investors with different needs. And concluding, much work to be done in the future to basically map these differences in risk exposures more closely to investor preferences. Thank you. And sorry again, I should have looked at the captions.
No worries. Thank you very much. Now we are going to leave the floor to Leonard Kostovetsky from Boston College. Leonard, you have the floor.
Okay, thank you very much. You can hear me? Yes?
Yes.
Okay, great. So thank you, Simona. Great presentation. Thank you for inviting me to discuss this excellent paper. So let me get into it right away. So I think this paper really is about asking three related questions and trying to answer three related questions. So the first question is, what is the best way to classify investment products? And this is really important because this is used for performance evaluation, for picking the right benchmarks, for marketing to investors. So we really want to know more about how to do this correctly. Second question is related to how portfolio managers basically do their job. What strategies do they use, methodologies, processes, and techniques? And then the last question is, so we know there's been this proliferation in the number of investment funds, in the number of categories. There's been much more market segmentation as a result based on these different categories. And we want to know, how do we explain this proliferation? So how do we think about this question of style or categorization? So prior research has approached this in a number of different ways. The most common way is to use the data from commercial providers who themselves select which fund goes into which category. So these are some of the popular data providers. Probably everyone knows about the Morningstar boxes, the 3x3 box of small, large, mid-cap, value growth blend, and those are often used as controls in the mutual fund literature. So that's, I think, the most popular way of classifying. But other people have used other techniques, classifying based on past returns, using the self-designated benchmarks, which are already in the prospectus chosen by the fund itself, or using fund holdings. So that's what the prior literature has done. So this paper, I think, takes inspiration from the Hoberg-Phillips approach. So they use the filings, they use the text in the filings to try to get information about classification. And specifically, they use two sections in the fund prospectus, the PIS, Principal Investment Strategies, and the PIR, which is the Principal Investment Risk section. Okay. So what can we learn from this text? They're not the first ones to use mutual fund filing texts. As Simona mentioned, Jerry Warner and I have a paper where we also use this section, the PIS section, or at least a part of it, from the prospectus, and we show that you could actually get information about the strategic uniqueness of funds, how innovative they are, and then look at whether that predicts mutual fund flows. And then there's also a number of papers that take a different section of the prospectus called the letter to shareholders and also do the same thing, do textual analysis, look at sentiment from those letters, and try to understand whether that predicts investor behavior. So again, this paper goes deeper, goes beyond that. So brief outline of the results. So they use textual analysis. Basically, the main heart of the paper is that they use textual analysis to classify domestic equity mutual funds into 15 categories called peer groups based on strategy, and also 12 other groups based on risk. And then they show that these groups, that the textual similarity predicts future similarity in returns even after controlling for past returns. So the textual similarity has some value even for when you control for past return similarity. And more broadly, they show that these peer groups that they've created, they have very distinct distributions of returns and very distinct factor loadings, which is consistent with them actually having some informativeness. All right, so what can we take from this paper? What can I say about this paper? Well, first of all, I think this is a very well executed, well-written paper. I enjoyed reading it a lot, and I really enjoyed how they took this unstructured text, just a bunch of words, and they very cleverly and rigorously constructed the peer groups. And I think really the strongest part of the paper, the biggest contribution of this type of analysis is that the peer groups capture many dimensions of style. So this is not just one-dimensional style. This is not just style looking at, for instance, the stock characteristic. This is what Morningstar picks up, whether it's they invest in small caps, growth, etc. But they also pick up things like the fund objectives. Is the fund trying to provide investors with steady income of dividends, or are they also giving capital appreciation? Strategies, quantitative models versus product-oriented versus industry-based. Do they allow other securities to be included in the portfolio, bonds, derivatives, etc.? Do they allow other risky activities such as short sales and leverage? And what are the kind of risk factors that are potentially affect the fund? So what's nice about this is that it's much, much richer than just looking at the Morningstar data. Now, the question then arises, how do we use this data? This is great data, lots of information here. What can we do with it? So some of the things that they do, I think we already know. So for instance, we know that portfolios based on stock characteristics generate different return distributions, right? Small cap versus large cap portfolios have very different returns. Bonds versus stocks have very different returns. If you change the market factor, loading on the market factor using leverage or by shorting, that's going to affect the return distribution. So I don't know if that's where really this data can really contribute a lot. But what do we not know? Well, we don't know where funds fit into this multi-dimensional definition of style. We don't know about whether these text-based measures are actually better than traditional measures like those from Morningstar. Should we use text-based instead of Morningstar? And we don't know much about this risk section. The risk section is completely new. No one has looked at it before. Is it just there for legal reasons, or does it tell us really something about the riskiness of the fund? So before I get to my suggestions, I just want to give you an example of this one of these sections, just so you could see what it looks like, and this will give you some idea of where I'm going. So this is from Fidelity Magellan, well known, probably everyone has heard of this fund. This is from 2 days ago. I'm not going to read the whole thing. This is the entire investment strategy section, but there's 4 main points. The first sentence says they invest in stocks. The second sentence says that they're allowed to invest in foreign stocks. The third one says that they don't have to buy value or growth. They could do one or the other or both. And then the last section says they use fundamental analysis or bottom-up techniques. So as I looked at this, I said, you know, what is the right peer group for this fund? It looked like, if you look at all the peer groups in the paper, this looks like it could fit in a bunch of different peer groups. There's not one that's natural just by looking at this text. Okay, so this brings me to the first suggestion that I have, which I call the many faces of style. So traditional measures of style, they put each fund into one category. You're either a gold fund or a small cap equity fund or a long short fund, or et cetera. But because the prospectus has so much information along multiple dimensions, I'm not sure it makes sense to just stick it into one category. So I'm not sure that the text-based peer groups should be mutually exclusive. You could have an equity mutual fund that uses quantitative methods, that's peer group 3, is allowed to use leverage, that's peer group 10, and invest in small cap stocks, that's peer group 11. So I would really urge the authors to maybe consider how, if they can adapt their methodology to allow funds to be in multiple peer groups or in multiple groups, and see if that gives you some interesting results. My second question is about whether these text-based groups actually add value. So we already know that style is important, so just showing it using these text-based measures, I think it's a little bit too low of a hurdle. I think the better question is, does text-based style beat other measures of style, like those from Morningstar or any of the others that have been used in the literature? This is very easy to do by running potentially a horse race among different measures of similarity, or by just doing textual similarity within a particular style. And the paper already does this to some extent by restricting their sample to a small part of the mutual fund universe. In addition, I would really focus on the dimensions of style, which are orthogonal to past measures. So we already know about like the Morningstar style measures, which look at holdings. That's not very interesting. What we don't know a lot about is, what about top-down versus bottom-up? What are the differences between those? Industry picking versus stock picking. Quantitative versus discretionary. And Simona mentioned she already has a paper that has started looking on this, but perhaps it could be expanded. A lot of the peer groups are related to flexibility, to use leverage, short sell, invest in non-equities. A natural question is, does flexibility lead to better performance? And what generates changes in these dimensions of style? Are they company driven? The family decides we're going to go from top down to bottom up, or are they manager driven? My next point is about the samples. So the sample consists of active, domestic, diversified equity funds. And funds are screened out, and that's less than 20% of all mutual funds. And the funds are screened out based on the commercial databases like CRISP and Lipper. So then the question, of course, comes, at least to me, it seemed, why are we using the commercial databases? It seems to be going against the spirit of the paper, which is that these commercial databases are creating artificial groups that are not based on the data. In addition, many of these peer groups just don't make sense in the context of active domestic diversified equity funds. There are no long short funds. There are no real estate funds. So those peer groups, they don't make a lot of sense. And if you just recall Fidelity Magellan, the sentence that said the advisor may invest assets in foreign issuers, that doesn't mean that Fidelity Magellan is a foreign fund. It means that they potentially, if some good opportunity comes about, they could invest in a foreign stock. And if we look at their actual allocation, it's very small. It's only 2% of their investments are in foreign stocks. So my advice here would be that I think you could take advantage of the much larger heterogeneity in the mutual fund universe and not restrict the sample just to these active domestic diversified equity funds. And I think you would get much richer set of peer groups as a result. And then my last set of suggestions has to do with this risk section. Can we really learn anything from the risk section? Again, I'm going to quote Fidelity Magellan from 2 days ago. The first sentence is many factors affect a fund's performance. And then the very next point is developments that have disrupt global economies, ... such as pandemics and epidemics may magnify factors that affect a fund's performance. So clearly they just threw that sentence in there in the last couple of months due to the pandemic. And it seemed to me that we couldn't really rule out that funds are just listing everything that they can, all the possible bad things that could happen in the whole world. In this case, a pandemic happened, so they're going to include that to avoid shareholder lawsuits. One way to do this is potentially look at whether the risks that they include actually are, the funds themselves are sensitive to those risks. So if they're in the interest rate risk category, are they more sensitive to interest rate risk? If they're in the cyclicality risk category, are they actually more cyclical? All right, so to conclude, I think this is a great paper. I really enjoyed reading it. I recommend it to everybody. I think they do a really, really nice job with textual analysis, drawing out a lot of the information that is in these sections of the prospectus for us to learn a lot more about what funds are actually doing, their strategies, their objectives, and their opportunity of things that they could do. There's also, I think, a lot of potential applications that are not explored here. So I think this paper has a lot of potential offspring or extensions, etc. And I'm very much looking forward to reading all the other papers that will come from using this textual analysis based on style. Thank you.